right, I think we are about ready to get started here. This is our Money Skills for Life class, and this is actually class 9 of our 12-part webinar course where we are discussing various financial literacy topics and personal finance issues. Now, these topics are skills that you can apply to real-life situations, not only now, but throughout the rest of your lives. My name is Michelle, and I will be your instructor for the class. My background is in finance, and I have been in the field for many, many years now. And that's because I enjoy sharing my knowledge and helping others achieve their own financial stability and freedom. And I also think it's really important for young adults and students to learn these skills as well, as it helps them make sound financial decisions in the future. Now, last time we discussed risk management and how we can manage certain risks in various ways, either by reducing our exposure to it, maybe transferring a portion of our risk, and that can be done in the way of usually with insurance policies. We can accept the risk. We can hold the entire amount of risk in our own hands. And we do that usually by establishing an emergency fund to kind of offset some of those surprises that may happen. And if possible, we can avoid the risk altogether. If we're worried about a sports injury, if that's one of our big worries of risk, then we can just not play sports, right? If we're worried about getting into a car accident, we can not drive or ride in a car. So we can, tend to avoid certain risks, but definitely not all of them. So then we would need to decide whether reducing, transferring, or accepting the risk would be our best option. Now, today we're going to be discussing debt management. And I think debt often gets a bad rap by financial coaches. And I know that a lot of coaches say, just you can't have any debt. Any debt is bad debt. And so I do want to point out that debt management does not mean no debt. It doesn't mean debt-free. And we'll see here in just a moment how there are good debts and bad debts. And so having a good debt on your side is definitely not a bad thing. Now, before we look at managing debt too much, I really want to get a better understanding of what debt is. Now, debt occurs when we borrow something. So, for example, if my phone battery, if I'm at a friend's house, and my phone battery is dying, then I can borrow her phone charger to top off my battery, right? Now, as soon as I'm done with that, I give the phone charger back. It's not mine to keep. I was borrowing it. And the same thing happens when we borrow money from a bank or financial institution. It's simply when a mutual and hopefully fair agreement has been made. And if that is the case, it can totally be a good thing. Just because I borrowed my friend's phone charger wasn't a bad thing. It was useful for me. It was helpful for me. And so can good debt. So debt isn't always a bad thing. It's just simply a balance between how much debt you have and how much income you have. And this is where we get the term managing debt. Now, debt can help you purchase something that you don't already have that can better your financial situation. So that would be good, right? So, excuse me. As I mentioned, we have good debt, which we also call productive debt. And good debt can increase your net worth or help increase your income or help increase your value. And this just means that whatever the worth of it is, that you owe less than, right? Let's take, for example, a house. Now, a house typically appreciates in value. And so let's say that I get a loan for $100,000 on a house. And as I'm paying that monthly payment towards the house, then my balance on that is going down. In addition, with the house increasing in value, is what we call appreciating in value, that worth or that value of the house can also be going up in value. So where it was maybe $100,000 in value, maybe now over some years it's $120,000. So that gap in between what I owe and what it's worth is what we consider that net worth. So your net worth, and we've discussed this in a previous class, are all of your assets minus all of your liabilities. And that gap in between is really what we're looking at. We're wanting to grow that gap in between. So a house typically increases in value, and over time that balance decreases. So that's going to give you that higher worth. But also a house can be useful in that you have to have a place to live. And so if I'm not paying and kind of building equity, paying that payment towards my own house, I'm going to be paying it somewhere else, maybe to someone else to lease a house, maybe to an apartment complex to rent an apartment. And so you have to weigh whether purchasing a house, or if you're eligible to purchase a house, if your credit score is not high enough, then you may need to rent or lease until you can increase that score enough to where you can get a fair and agreeable term. Student loans work the same way, even though it's not something that I have like a house, a piece of property. It's knowledge. And so by increasing my knowledge, taking, courses in college or certifications, designations, whatever it may be, student loan debt can be good as well because it increases my knowledge. I may gain a higher level of skills and be able to obtain a higher paying job. So that's going to increase my eventually my net worth and my income as well. Where we see bad debt, or what we can consider non-productive debt, are those things that don't increase my income or don't increase my net worth. And these are primarily like credit cards, personal loans, furniture loans, department store cards. I mean, I know that that pair of shoes or that sweater or jacket like really will look good as you go to work in the office, but it's not going to necessarily increase the value. Now, vehicles are kind of in a little bit of a gray area because they tend to lose value rather quickly. And I know there's a phrase that says, as soon as you drive it off the lot, it depreciates in value. I know there's a phrase that says that as soon as you drive it off the lot, it depreciates in value by 20, 30%. And but you may need that to get to and from work to earn income. So as long as you it kind of falls in that same category as the student loan, by getting to work and being able to use your skills, it does increase your value by increasing your income. So that's a little bit of a gray area. It can be considered good debt if those terms are fair. Now, there are many types of debt. We have secured, unsecured, revolving, non-revolving. Now, a secured debt is where collateral is put up. What is collateral? Well, collateral is some item worth the debt amount. So for example, let's look at a vehicle. Let's say that I need a vehicle to get to and from work. And I find one for sale for $20,000. And the value of the car is $20,000. And so the bank or financial institution, if I have a good credit score and I'm not too overly leveraged in any other debt, then I will probably be able to get that vehicle. They'll loan me that money to purchase that vehicle. Now, if it's valued at $20,000 and I'm asking for a $25,000 loan, probably not, because it's not worth that same value. So usually a bank or financial institution will loan you either that value or below, because if you decide to quit paying for it, they're going to need to get their money back somehow. So as long as you continue to make your payments and according to the terms of the loan, you keep possession of that vehicle. But at the moment you default on that, they can repossess that item of collateral and sell it to recoup any of their losses. Now, an unsecured loan works a little bit different because there is no collateral. It's unsecured. And this could be medical bills, student loans. You're gaining knowledge in your brain. The student loan financial lender can't repossess your brain. They can't repossess those thoughts that you learned, that subject matter. So it's considered unsecured debt. Now, revolving and non-revolving are kind of revolving and non-revolving are a little bit different because you can have multiple things. You can have a secured loan that's non-revolving. For instance, a mortgage. A mortgage is secured by the house and it's non-revolving. It means that it's for some specific debt, like a mortgage or a vehicle. And a revolving would mean that you have, let's say, a credit limit. So let's say on this credit card, you have a limit of $5,000 and you have a $1,000 balance. That means you still have access to $4,000. It's open and it revolves and you have access to that full unused amount. If I pay off the $1,000, I have access to $5,000. If I charge $3,000, I only have continued access for $2,000. If I pay $1,000 off and I only have a balance of $2,000, I now have access to $3,000 again. And so it's open and I can use it for whatever I want. So usually revolving are also unsecured. It can be a little bit different. You can have an unsecured debt that is non-revolving, for instance, like a signature loan or a personal loan, but credit cards are typically always unsecured because you're not really securing it with any type of collateral. If I go to the store and I buy groceries, they can't come back and repossess my groceries. They're already in my belly. They're not going to get them back. And so revolving credit cards are usually always unsecured, and keeping a low balance on those is important because with a secured loan, like we mentioned, if something happens and you default on those payments, the financial institution can come back and get that collateral, that car, and sell it and recoup some of their losses. However, they can't do that with food, groceries, pair of shoes. And so for this reason, typically secured loans are offered at a lower interest rate, whereas any type of unsecured are offered at a higher rate. So how does this make a difference when we're looking at interest rates on loans? So when you make a payment, part of that payment goes to interest and the other part goes to principal. So whatever is accrued in interest is going to be applied first, and then whatever remaining is going to be applied to the principal. And this is per payment. And so let's look at this. If we add the interest and the principal up on this, we can see that the payment would be $497. So this 347 plus 150 equals 497. If we add 148 plus 349, we will still get this 497. So of this $497 payment, we can see that on payment one, 150 goes to interest, 347 to principal, leaving us a new balance of $29,653. So obviously this was a $30,000 loan. After we make our first payment, our balance is now $29,653. Now the interest is now calculated on this remaining balance, which means that the interest went down just a touch, and it continues to go down every time we make a payment. In addition, the amount that is going towards our principal is increasing in value every time we make a payment. That leads us to believe that the lower the interest, then the more principal will be made on that loan. So let's assume that this example, it is a 7% interest rate. I have no idea if it's 7%. We're just going to throw that number out there. So every time we make that payment, 7% annual percentage is going to go towards this. So if we can get a lower rate, less would go towards that interest, more would go towards that principal, and our balance would decrease faster, which is why it's important to have a good credit score. Because if we have a better score, we often get better offers when we apply for a loan. Now, again, debt is not a bad thing. When it becomes a problem is when you have trouble paying that debt back. And a person can only handle so much debt based on their income. And this is the amount of what we consider kind of safe debt. And it's calculated and by running by running a lot of different ratios on it. And one of those ratios is considered what's called our debt to income ratio. Now, what we do, and there's a couple different, as we'll look at in just a moment, a couple different figures that we can consider. But what a debt to income ratio looks at is all of your debt based on your income. And so we take all of our debt, we calculate it up, and we can see here, if we calculate these, we'll have $2,500 in monthly debt payments. We have a $4,000 monthly income. We divide our debt into our income, and we can see here our debt to income ratio is 62.5%. That means that 62.5% of our income is going towards debt. That doesn't mean that it's not taking into account our groceries, our utilities, any type of fuel for the car maintenance. This is just things that we've already spent money on that we're having to pay back. We've already borrowed all of this money, so now we're having to pay that back. And if we see here, installment payments are usually going to be a secured loan. Usually, doesn't have to be, but line of credit, that's kind of one of those revolving credit lines or revolving debt. So this is going to probably have a higher interest rate. We know our credit cards may have a higher interest rate. Mortgage, probably not as high. And this installment loan payment, maybe a car payment. And so this may not have as big of or as large of an interest rate either. But still, when we add all this up, 62.5% seems a little bit high. And according to the factors, they are. Non-mortgage debt, which is car loans, credit cards, department store cards, should really be popping in at under 20% of your income. Mortgage, just the mortgage alone, which is your principal, interest, tax, and insurance, what we call PITI, P-I-T-I, should be no more than 28% of your income. And your total debt, which are both of these together, should be no more than 36% of your income. So if we look back at that previous example, we had a $1,500 mortgage, $2,500 total on debt. So we know that $1,000 was going to the other stuff. And so if we can calculate that out, we can see that we were about on our mortgage about 37.5%, because we would take 1,500 and divide it by 4,000. We'd be about 37.5. So we were definitely over on that. Our non-mortgage debt was 1,000 divided by 4,000 would be 25%. So we're over on that as well. And then on our total debt, we noticed that that was 62.5%. So we're definitely over on that too. And that's where we get into a situation where we're over leveraging ourselves. And that's what leads to trouble paying that debt back. And so if we have 62.5% of our income going to, we've already obligated ourselves, we may run into a situation because we only have that remaining amount of 35%, or actually 34.5% to go pay for other things like groceries, utilities, medical, prescriptions, car repairs, fuel, anything else that we have. And if an emergency happens, then we may not have enough money. And if we're already paying back on credit cards, we don't really want to take more out on a credit card because what? The interest rate's usually higher. So by having some money set aside if an emergency happens, it helps us out a bit. But if we're too overly leveraged with debt, it makes it really hard to do that. So some debt is definitely good because it can help us increase our value, increase our net worth, increase our income. It also, by having debt on your account and you're making payments, you keep your credit score and your credit history active, which means that's going to help with your credit score. And if your credit score is healthy, then usually you will have those better offers when it comes to the interest rates and the terms of the loan that you may be offered. So the activity allows lenders to offer you better rates, better terms, and possibly better situations for your financial life. And as we can see here, too much debt can definitely drown us. It is where we look at that good debt and the bad debt, and having too much, even having too much of good debt can be troubling for us. As we saw in the debt ratio, while we consider a mortgage a good debt, we only want it at that 28% mark. Going over that can be considered too much of good debt as well, which then makes it bad. So instead of it having a good effect, it does the opposite. Any questions so far? No questions? Okay, well, if we don't, our next time to meet will be June 4th, where we will be considering and digging into some consumer awareness issues. And these are things like false advertising or deceptive practices, fraud, predatory lending, maybe some warranties, refunds, product recalls, and what to do if you get billed on something incorrectly. So until next time, take care and continue to practice good money skills. See you next time.